Alrighty, monetary policy part 2, and this looks like it could very well be our last video. Yay! You guys are done. Congratulations on a great job this semester. Here is our questions. Obviously not. Let's see. Here's our video questions. What you guys want to do is we'll just pause it here and write all these down. Alrighty, when looking at money, what we first do is we look at what are the functions of money, the 3 functions of money. And the first one is very simple. It is, again, the medium of exchange, standard of value, and store of value. Medium of exchange, what does that mean? It means this money can be exchanged for a good or service. That's what we use. Standard of value is what are things worth? We compare it to how much is the monetary value of something. Something has a lot of value, it's worth a lot of money. And then the store of value, how much does something keep its value over time? We look at it again in relation to money. However, what eats away at this is called inflation. Inflation eats away at this. So these are the 3 functions of money, what money does. Then what are the 5 characteristics of money? Money is durable. It can last a long time. Money is portable. You can put it in your pocket, take it from place to place, put it in your car. Money is divisible. 1, 5, 10, the pennies, the dimes, the nickels. Money is accessible. You can get it. Typically, you guys go to an ATM or the never-ending ATM. It's called Mother and Father. And it's stable in value relatively. But what eats away at that, again, is inflation. So those are the characteristics of money. What are the 3 sources of value? We have what's called commodity money, representative money, and fiat money. This is basically a history of money through time. Commodity money was anything used as money, or used as a medium of exchange, used as money. An example would have been tea leaves and spices back in their early days. We can still do it today. You barter, you trade. That can become considered commodity money. Representative money is something that was backed by gold. So our money used to actually be backed by gold. You could take it to the Federal Reserve. The local bank is in San Francisco. Take it there and say, I want $10 worth of gold. That's called representative money. But now we have what's called fiat money. And the government decrees that this money is worth whatever it says it's worth. It's worth $10. Why? Because the government says it is. It's not worth $10 of gold. I wish it was, because gold prices being so high, it would be worth only a flake, but it is what it is. So there's fiat money, commodity money, and representative money. Think of it as the history of money. So taking a look at the money supply, the first thing you got to look at is liquidity. How fast can you get your cash? Turning your assets into cash, this is the measure of someone's immediate wealth or someone's wealth. You might be worth $50 million, but it's not liquid. You don't have it immediately. You have to sell certain things. So your assets, maybe their value is appraised at $50 million, but until you can actually sell it, until it's actually liquid, it's not worth that kind of money. So looking at the money supply, then it's all about liquidity. How fast can you turn those things into cash? If you really want to look at how much money is out in the economy, there's 4 different ways to look at it. You have M1, which is the narrowest measure of the money supply. You're not looking at anything else but actually things that are the most liquid. That's why I put this here. That's example of cash, checks, traveler's checks, and ATM deposits. These are the most liquid. The wider measure than M1 is called M2. It includes M1, but also includes money market funds, savings deposit, and small time deposits, and certified deposits or CDs. So this includes things that more or less savings, bigger savings accounts and bonds and things of this nature. It's not immediately liquid, but it won't take that long to get liquid. So how do we usually look at the money supply? Are we looking at M1, just what's the cash is out there? Are we looking at things that are in savings and things that actually are cash but are being saved? So that's M2. M3 is M1, M2 plus large deposits, large savings deposits, large CDs and things of this nature. And then the broadest is L, which includes M1, 2, and 3, and this is the largest measure of the money supply. Basically looking at almost anything out there that it could represent cash. So when we're talking about the money supply, what are we really focusing on? What are we really looking on here? And controlling the money supply, and that's the job of the Federal Reserve. And so what is the Fed? It was created in 1913 with the Federal Reserve Act to think about the bank scares, 1909 bank failures that happened then. And then after the bank runs of the 1930s with the Great Depression, we had what was created the Federal Deposit Insurance Corporation. The FDIC is what it is called. And there's 12 branches throughout the United States. San Francisco is the closest branch to us right now. And what are the jobs of the Fed? Helen made a cameo. First job is to maintain currency, replacing old bills with new ones. It is also then what we know as the banker's bank. Bankers use it to put their money there, to store their money there, if you're a member. It's the government's bank. Tax refunds and Social Security checks are sent from the Fed. It's a clearinghouse for checks. What all that means is this is the method for crediting and debiting banks' reserve accounts. And in turn, they have their own check accounts, so they send checks there. The bank gets money for that. Regulating banks, which they probably didn't think of in 2008, didn't do a great job with that. And they supervise member banks, make sure that they are following regulations, they have enough things, and they're following whatever it is the Fed put out there. However, the most important job of the Fed, and it's controlled by the Federal Open Market Committee, and it's called monetary policy. And we talked already about what monetary policy is. That's the most important job of the Fed. The structure of the Fed, this is the very top of the pyramid. The Fed, the 12 banks, and then underneath that, you have these 12 banks are spread out throughout the United States. New York is typically the most powerful. That is the head bank. Then your chairman of the Fed is Ben Bernanke. And then you have the Board of Governors, and these are 7 members, 14-year terms appointed by the president, obviously. And then you have the FOMC, and the FOMC, the Federal Open Market Committee, is made up of the Board of Governors, so these 7 members, plus 5 presidents of the 12 banks. This changes except for one. The New York Bank is always the same, and so 4 other banks, it rotates. And the FOMC, what do? Their most important job is to decide monetary policy. So that is the structure of the Fed. And we're looking at the supply of the money. That's what monetary policy is, how much money is in the economy. You have what's called the money market graph. And this deals with interest rates here, because that's all you're doing is lowering and raising interest rates. This is in a recession. So if we started here, this is 1, and you push it here, you are lowering its interest rate. That would be 2 right there. This would be PL1, PL2. And this, in turn, is going to be a recession because it is going down, so the interest rates are going down. And then the opposite of that would be inflation. Interest rates would be going up. This is PL1, this is PL2, interest rates going up. There is the money market graph.